Okay, in the previous YouTube video, we took a look at contribution margin and various calculations. And here is an example of those calculations. Molly Company sells 20,000 units at $12 per unit. So that's the sales price for one unit. The variable costs are $9 per unit. And the total fixed costs are $25,000 for the period. They want you to determine the contribution margin ratio, the contribution margin per unit, and the income from operations, also known as operating income. So let's do that backwards. Let's do the operating income. So that shows you here our sales is $240,000. How did we get that? We took the 20,000 units we sold, and each unit was sold for $12. So 20,000 times 12 is $240,000. The variable costs were $9 per unit times the 20,000 units is 180,000. So 240,000 minus 180,000 equals 60,000. That's our contribution margin, our total contribution margin. Our total fixed cost was $25,000. We subtract that from the contribution margin, and we get income from operations, also known as operating income, of $35,000. Okay, so there's our answer to letter C, $35,000. Now, letter B, it wants the unit contribution margin, or the contribution margin per unit. So we take the sales price for one unit, which is $12. We subtract the variable cost per unit of $9, and we get $3 per unit. That's our contribution margin per unit. And then letter A is the contribution margin ratio. That can be done two ways. I can take my contribution margin total, which is $60,000, divided by my total sales, so $60,000 divided by $240,000, and that equals 25%. Or I can do it by per unit. I can take $3 contribution margin per unit divided by the sales price per unit, which is $12. 3 divided by 12 is also 25%. Now, one thing that we utilize this contribution margin calculations for is determine a break-even point. And the break-even point is how many units do we need to sell just so we break even? In other words, so that operating income is zero, where we've covered all our costs, even though we've not made any extra profit. Oftentimes, when we first start a business, oftentimes we're going to have a loss. So we want to know how long is it, we want to have some kind of idea how long is it going to take us to get to the point where at least we're breaking even. And then after that, after we have break even, for a year or two, then finally we've built up enough customers and enough products and everything that we can start making profit after that. So this tells us how many units are we going to have to sell just to break even. And so you're going to have good estimates of your variable costs, your fixed costs, and what kind of sales price you want to have, etc. This is also used, let's say, even a big company that's already well established may decide to open a different product line. Well, they're going to want to see how long till we break even on this particular product line. How many do we need to sell? And maybe we'll find out that we need to sell so many of them, we don't even think we can sell that many, so we're not going to bother, okay, even starting this. And it's a lot better to do on paper than to put in millions of dollars into developing a new product line and then find out that, oh, no, we're never going to even break even. So a lot of this is done on paper. Okay, so here's an example. Barker Corporation's fixed costs are estimated to be $90,000. Okay, the unit contribution margin is shown as follows. The sales price for a unit is $25. The variable cost for one unit is $15. So 25 minus 15 is $10 contribution margin per unit. Okay, so we're going to use this information. We're going to use these fixed costs of $90,000 and this unit contribution margin of $10 to see how many units we need to sell to break even. Okay, and so we have our contribution margin per unit, which we did. Now we're going to use that. The formula for break even is the TFC, the total fixed cost, which was $90,000, divided by the contribution margin per unit, which is the $10. So the $90,000 fixed cost divided by the contribution margin per unit, and that tells us 9,000 units. So we're going to have to sell 9,000 units before we can even break even. And then it becomes a marketing question. Can we sell 9,000 units? Is it possible? Or is that a drop in the bucket? We think we can sell 100,000 units. So this is good. Okay. Now, we can go ahead and prove that the 9,000 unit is the correct answer, okay, by filling out a contribution margin income statement. Okay, so our sales was $25 per unit times the 9,000 units we just figured out. That's 225,000 of total sales we would have. Then the variable costs were $15 a unit times the 9,000 units. That's 135,000. So 225 minus 135 is 90,000 would be our contribution margin. We subtract out our fixed costs, which are 90,000, and that gives us 0, our operating income. So we have broke even. By selling $225,000, which is 9,000 units, we will cover all of our costs, but we won't have any extra profit. Okay, here's another example. Nicholas Enterprises sells a product for $60 a unit. Variable cost is $35. Fixed costs are $80,000. So first we calculate the contribution margin per unit, which is the 60 minus the 35. That equals $25 per unit. Then we can do the break-even formula, which is the total fixed cost of $80,000 divided by the contribution margin per unit, which is $25. 80,000 divided by 25 is 3,200 units. So if we sell 3,200 units, we can break even. Okay, now this is a related topic to the break even, target profit. Let's say, okay, we're beyond break even. We want to know how many units do we need to sell to not only break even, but also to have a certain amount of operating income, a certain amount of extra profit above break even. So we're going to use the same formula, only we're going to add target profit to the numerator. So we're going to take the total fixed cost, we're going to add that target profit to it in the numerator. We're still going to divide by the contribution margin per unit. Okay? Now let's say in this next example, we want to make an operating income profit of $100,000. Okay? So here again, we're using the sales price of 60, variable cost of 35, fixed cost of 80,000. But now we also have the target profit of 100. So first we calculate out the contribution margin per unit. 60 minus 35 is 25. Then we have our formula. We take our fixed costs, 80,000, plus our target profit of 100,000. That's our numerator, so that's 180,000. Then we divide it by the contribution margin per unit, which is 25. So 180,000 divided by 25 is 7,200 units. Okay, we need to sell 7,200 units, and we would end up with 100,000 operating income. We can prove that by doing a contribution margin income statement. We have our sales. We're going to use the 7,200 units we just calculated times $60 a piece. That's the sales price per unit, 432,000. Variable costs, the 7,200 units we just calculated times $35, which is the variable cost per unit. That's 252,000. 432,000 sales minus 252,000 variable costs equals 180,000 for contribution margin. We could also take the 7,200 units times the contribution margin for 1 unit of 25, and that would also give us the 180,000. Okay, then we subtract off the fixed cost, which was 80,000, and that gives us operating income of 100,000, and that's what we wanted. So we've now proved that the 7,200 units is the correct number. Here's another example. The forest company sells a product for $140 per unit. Variable cost is $60, fixed cost $240,000. Okay, we need to determine the break-even point and a break-even point if they desire sales target profit of 50,000. Okay, so for letter A, we have the 240,000. That's the fixed cost divided by the contribution margin per unit, which is the sales price per unit, 140, minus the variable cost of 60. 140 minus 60 is 80. So we have 240,000 fixed cost divided by the $80 contribution margin per unit is 3,000 units. We want to break even, we would have to sell 3,000 units. Now, what if we want the target profit of 50,000? Now we take the fixed cost of 240 that we already had, but we're going to add the extra 50,000 onto it on the numerator. So now we're talking $290,000 in our numerator. Our denominator is still the $80 contribution margin per unit. So 290,000 divided by 80, that gives us 3,625 units. So if we sell 625 extra units, we would have $50,000 in operating income.